the IMF has just published its Fiscal Monitor. Here is Carlo Cottarelli, Director of the Fiscal Affairs Department, outlining its key findings.
Our latest report takes stock of the progress made in terms of fiscal consolidation since 2010. And the good news is that after skyrocketing at the beginning of the crisis in 2008-2009, fiscal deficits have now come down significantly in most countries. This is especially true among advanced economies where the shock hit hardest. So in the near future, the challenge for policymakers will be to keep bringing deficit down without undermining the economic recovery, which is still fragile.
Advanced economies that came under market pressure had to front-load adjustment. Their fiscal balances improved strongly in 2011. More is to come next year, adding up to a total improvement of 4.5 percentage points of GDP over 3 years. Other advanced economies adopted a more measured pace of deficit reduction. For 2012 and 2013, a total improvement of 1.75% of GDP is projected. For most emerging market economies, the need to consolidate their public finances is less acute. They had stronger fiscal starting positions and were not hit as hard by the financial crisis. Yet many of them made progress in strengthening their budgets.
Public debt ratios in advanced economies are still very high, which keeps these economies exposed to the mood of financial markets. In many countries, it will take several years to bring public debt down to more sustainable levels. So consolidation will be a theme of public finance for a very long time.
This chart shows in blue the number of advanced economies in which the debt ratio is falling. Based on our current projections, the number of countries where debt is falling will not exceed the number of countries where it continues to rise until 2014.
In some countries with the largest adjustment needs, deficit reduction had to include investment cuts and also broad-based tax increases that may weigh on long-term growth. Fortunately, many countries also focused on measures that will support growth once the consolidation phase is over. A good example is pension reform. It reduces long-term pressures on the fiscal accounts without hurting domestic demand in the short run. Indeed, pension reform can even raise growth in the long run because it encourages people to work for longer.
This chart compares how our pension spending projections over the next 2 decades have changed since the crisis. Due to reform efforts, expected increases in pension expenses will be much lower in countries such as Greece, Italy, Spain, Iceland and Ireland.
Despite considerable progress, fiscal consolidation remains quite challenging. As we said a few times in the past, it should proceed at a steady pace in advanced economies, which means that if growth is a little slower than expected, policymakers should not tighten fiscal policy but stick to the measures they have introduced and tolerate a bit larger deficits. If, on the other hand, growth is a little faster than expected, policymakers should take advantage of stronger revenues to bring down headline deficit faster rather than spending the extra income. Of course, in case of a much sharper slowdown than currently projected, advanced economies with room for maneuver should slow down the pace of consolidation, provide the support to the economy now, without losing sight, however, of their longer-term objectives. In contrast, most emerging and low-income economies can afford to pause their fiscal adjustment now until the growth outlook improves. Indeed, they are doing this already in 2012, given the weaker growth outlook.